Hello everyone, my name is Dr. Melissa Cohen. So today we're going to talk about ratio analysis. So this is specific for corporate finance, and when you as an analyst or as an investor want to go and look at financial statements and you want to compare them between two companies, maybe even a point in time within the same company, you would do ratio analysis. And that is because when we're looking at overall sales for one period in proportion to another period, they may be different. So 5 years ago, sales may be $10 million. Currently, sales are $20 million. But how do we look at how much money we're spending on sales and admin fees versus what's our cost of goods sold proportionately? So we're going to do a ratio analysis, which is proportions as well. And the reason why you would do it when you're looking at two different companies is because, let's say, two car companies, Ford, GM, even Tesla, Volkswagen, Nissan, choose any two companies. And even though they make cars, and that's what their line of business is in the industry that they are in, their size of the companies vary greatly. So how do you compare two companies and how they're spending their money and how they're operating their business? You do that by looking at the ratio analysis. So we are going to begin. There are actually 5 groups or 5 categories of ratios when we're doing these calculations. So the first one is short-term solvency, or you can look at that as liquidity ratio. So short-term, meaning in finance and corporate world, is usually within less than 1 year. So that's how liquid, how fast can we turn those goods into actual cash. The second category is long-term solvency or financial leverage ratios. So long-term is typically anything more than 12 months. And usually when you're in that realm, we're also talking about how are we raising cash to pay for our growth and covering our cash flows. So those are going to be our financial leverage ratios. The third category is asset management or turnover ratios. The fourth category is profitability ratios. And the fifth is market value ratios. Now, the most important thing that you need to know about these ratios is, even though, as we talk about a couple of these, I'm going to go through some of them for you, is that not everybody may calculate them the same way. Like, we may slap one name in a calculation, but another analyst may do it differently, may use a different line from the balance sheet or income statement or something. So you also have to be diligent to know, if you are looking at somebody else's numbers and their other calculations, that you have to make sure that they are using the same numbers and same categories that you are. All right, so let's get started. So we're going to take a few moments to go through some of these short-term solvency or liquidity measures. The first one is the most easiest, is a current ratio. And that simply is current assets divided by current liabilities. So our current ratio should be easy to remember. Current ratio equals current. So our current ratio is current assets divided by current liabilities. So this is one of the most widely used ones. It's pretty simple, pretty easy to use as well. So you should expect that your current ratio should be at least 1. And a current ratio of less than 1, that means that the net working capital is negative, right? So if we're just looking at simple math and we have the numerator and the denominator, this number needs to be larger than this number to equal 1 or more. And so if it's less than 1, that means the bottom number is bigger, and to have more liabilities than actual assets is not great. So that's where, so the negative number is your net working capital is also negative, and you don't want that for a company. So our second ratio we're going to look at is called the quick or acid test ratio. So I'm going to write this out, the quick ratio. This is current assets minus inventory minus inventory. And we're going to divide all of that by current liabilities. So now you know this is similar to the quick ratio, except for we are actually subtracting inventory from our current assets. And what that means, or kind of what this quick or acid test ratio is calculating, it tells somewhat of a different story than the current ratio, because inventory usually accounts for more than half of a could potentially do half of a company's assets. So we want to take out what that inventory is. Obviously, if it's a company that has more inventory versus a service company that has very little inventory, that's going to be different as well. And obviously, as I said before, when we're looking at these ratios, and we're looking, let's say a car company, let's go back to that example. We're going to take out inventory. What does, Ford have sitting on hand? What does Volkswagen have sitting on hand? And that sort of thing. So we're going to take that out because the company may be sitting on a lot of inventory, and that's going to make the numbers change as well. So we need to be aware of what that is. Another ratio we can look at is called the cash ratio. And this is simply cash, so that should be easy to find, divided by your current liabilities. So hopefully this one will be easy to remember as well. Your cash ratio is cash divided by your current liabilities. So this is something that a short-term creditor is actually going to be very interested in knowing, because if they are going to give you money on the short term, they want to make sure you're going to be able to pay them, and you have to have cash on hand to do that if it's the short term. Now, if it's a long term, we're talking bank loans or stocks, things like that. So you definitely want to have this number available if you are looking for any short term loans as well. All right, so those are the basic or the main short term ratios that are used in corporate finance.